Hey, this is Mitchell with Option Wolf here. Today we're going to be going over trading long options and some strategies associated in doing so. So let's go ahead and dive right in here. A lot of retail traders like to take advantage of short-term stock moves by trading options, whether it be calls moving up, puts, if it's moving down. But there's plenty of other strategies uh, that are less typical that people trade in trading long options, such as married puts, stuff like that. So we're going to be getting into that stuff today. A protected put or a married put. When people are hedging their position with options, they'll typically hedge a third of the position in question, i.e., buying a put at a say 33 delta would effectively be hedging 100 shares or well really 33 shares at a third of that position. So when we're hedging with puts, we're buying puts 3 to 4 weeks out of earnings due to the low vega, and vega is what we talked about earlier, implied volatility. So we're looking at a 33 delta at one contract is what a lot of people go for in that strategy. So trend trading, this is kind of what we're doing when we're trading long options here. Trading when the market's in an uptrend or a downtrend. And one of the big tools that people use is called CCI. And, it'll likely be on your trading platform. But CCI, what you can do is put it long 50 days, like on a 50-day chart. So a high short-term CCI may indicate a drop or even a crash coming. So you put our CCI at 50 days, and when it crosses above that 100 mark, that's our entry mark there if we're going long. So that's where we want to buy calls. Use the zero line for a stop loss. I'm not saying that you should put a stop order in for your options, but that's where we want to exit and take a loss on the downside. And then we're also looking at an upward moving average for calls and the inverse for puts, a downward moving average. So on a downtrend, it's going to be the inverse here. Long CCI at 50 days, but we're entering when it crosses below negative 100. We're still using a zero line for stop loss on the upside, and we got a downward moving average for puts. When we're going long options, we want to look at typically 3 months out so we can get a big delta and a big gamma. We're also searching for more intrinsic value than time value, which is typically around a 7 delta, 0.7 delta, or 70, depending on what platform you're using. So that's where we want to enter, and then once we see that value rise up, the gamma delta relationship will start to diminish around at 85 delta. So that's when we want to roll up and out again to put that time on to where we're about 3 months out again and ensure that our new delta is around 0.7. So we want to stay in typically until 3 weeks before expiration, before that time value really starts to diminish. And then at that point is when we will roll up and out to 0.7, when it's around 85, 83 delta. So that's just a brief strategy with trend trading long options. We're going to get into more detail in our other videos, so make sure you subscribe to Option Wolf, and as always, trade safe.